Hi, I'm Russ Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Strategas President and Head of Portfolio Strategy, Nicholas Bohnsack, to talk all things markets. But first, Nick, how are you doing today?
I'm doing very well, Ross. It's good to see you, my friend.
Good to talk to you as always. Let's start with what I've heard you call, one of the key building blocks of markets, and that's interest rates and inflation. And I want to get your outlook for both how things are going in the U.S., but also abroad, because there are some other, key central banks at important moments right here.
Yeah, indeed. I think you've hit the nail on the head. I mean, inflation, sort of remains the Scrooge of this economy. Mercifully for central banks, both here and outside the United States, relatively strong labor markets have provided cover for monetary policy makers to remain a little bit tighter, perhaps than they otherwise would have. But it's the pressure starting to mount, and I think you're seeing economies, outside the United States in particular, start to show a little bit of positive momentum, and in as much there's a little bit of pressure to take policy from what might be considered restrictive to something that's a little bit more accommodative. And it seems clear that in Europe, where you've had four central banks that are not part of the European Union already cut, that the ECB is poised to join them sooner than later, and probably relative to the Fed, go a little bit further in taking more hawkish policy off the table. And so that provides a little bit of buoyancy to global shares. I think domestically, and as a number of Fed governors, presidents, and members have spoken to, inflation remains a little bit, stubbornly high. And so they're probably going to wait and see, and that probably means something closer to September before they're inclined to ease policy at all. So inflation is very much in the focus, but I think the balance of risks is sort of accruing more towards Europe and other developed economies.
Well, and on that point, I know you all recently upgraded developed economies, developed shares as part of your asset allocation framework. So I'd love if you could, expand on that, past just the central bank framework, but also, anytime you discuss investing internationally, there's kind of the gorilla in the room, which is China. So how are you thinking about developed economies and the interplay with China as you go abroad with your portfolios?
Yeah, all good points. And so a couple things I just want to pick at. It's not enough to really want to put, as an investor with a long-term time horizon, it's really not enough to just follow policy accommodation in our view. In fact, there's an old adage that you actually want to fear the cut, because that's generally in response to something that the central bank is seeing that is breaking. And actually, we've seen stronger market performance when Fed and other central banks have been on hold or paused, as they have been currently. So the easier accommodation that we're likely to get in Europe sooner is just one small piece of this. But what we're also seeing is positive economic surprise, positive corporate profits, and slightly higher activity measures in Europe and in Japan and in other developed economies. And that's really where we want to respond to, and ultimately, is the backbone of why we would recommend, a modest increase in allocation in developed market shares. China, as you mentioned, is always part of the equation. We think for long-term investors, it's difficult to invest directly in China. There's a number of reasons for that, but it's clear that the Chinese government is very likely to want to, keep their economy afloat and even stimulate their economy as they move into the year end, where of course they'll host the third plenum of the Communist Party. And so even though investing directly in China may be difficult, China that is resurgent provides some ballast, particularly for regional economies like Japan, like South Korea, and like Australia. So when you look at that in totality, the developed economic picture starts to look relatively stronger than here in the United States, where we're seeing a little bit of weakness in labor, a little bit of weakness by extension in the consumer, and a generally flat earnings paradigm that isn't enough to rock the boat and sort of tip it over, but is certainly some cause for concern, and is likely keeping our own Fed very much attentive to the interchange between earnings and inflation, as we mentioned a moment ago.
Well, let's finish with that earnings piece. We started with building block of interest rates. Earnings obviously very critical to the fundamental picture and fundamental outlook for U.S. stocks. We're kind of at the tail end of an earnings season here. What are you seeing? What are you seeing for 2024, maybe 2025? How are things shaping up from your perspective?
Yeah, so in a good respect, earnings have been okay. There's been a few areas of positive surprise, which I think obviously everybody responds well to. There's been a few areas of disappointment, but they have tended to be more stock specific and even industry specific, and so that really comes down and sort of underscores the point of a modest piece of active share in portfolio where you can pick between stronger operating teams. But on balance, earnings have been okay as we've come through the first quarter, and we wouldn't expect there to be much by way of surprise as we round out the first half of the year. I'd say if you look towards the second half of the year and even into the beginning of 2025, the key that I would focus on really are what the expectations are for top line, for revenue. The economy has one or two strong areas of organic growth. Certainly, artificial intelligence is among them. The labor market would sort of be a complement. But if those two don't flow through, the revenue numbers might be a little bit stretched. And so we'll want to watch for a downward revision profile to emerge for the second half of the year. But on balance, we still think we're going to see earnings up at least 8 or 9% year over year. That's pretty strong. Not enough to put the domestic bull market in abeyance, but also not enough to probably outpace its developed market peers at this point.
Nick, this has all been really insightful. I want to thank you so much for the time and hope we'll get a chance to talk to you again soon.
Can't wait, buddy. Be well.